Hello! Today I want to discuss how to complete the journal entries related to notes payable. But first, let's discuss what a promissory note is. A promissory note is a promise to pay a specified amount of money at some future date, typically with interest. The party on the receiving end of a promissory note is said to have a notes receivable, which is an asset account in some ways similar to accounts receivable. The party on the paying end of a promissory note is said to have a notes payable, which is a liability account in some ways similar to accounts payable. Now, promissory notes can be created for a variety of reasons, but some of the most common are in exchange for a service, extending a past due account, and making a loan. The focus of this video will be the journal entries related to notes payable. So now we'll turn to a problem. The problem says, prepare the journal entries to record the transactions listed below related to VTP Company. So in 2009, on November 17th, we signed a $10,000, 8% 120-day note dated November 17, 2009 in exchange for cleaning services. So before we record the first journal entry, let's calculate the interest related to this note. So we're going to calculate the total interest, the interest for 2009, and the interest for 2010. So this note was created in November 17th, and is going to last for 120 days. So therefore, it's going to be collected sometime in 2010. So therefore, this note is going to be outstanding in two different years, 2009 and 2010. So we're going to need to record the interest expense that's related to 2009 in that year, and the interest expense from 2010 in that year. So we have to calculate those separately. So the way we're going to calculate the interest is by taking the principal times the rate times the time. So first, the principal. They tell us that the note is worth $10,000. So that's the principal amount. And that's going to be the same for all three time periods. The rate is 8%. So in decimal form, that's going to be 0.08. So for the time column, we need to take the fraction of a year that the note is outstanding in that period. So in total, this note is outstanding for 120 days. So we take 120 divided by 360. Now the reason we use 360 instead of 365 is due to a convention that's called ordinary interest. And this was just a way to calculate interest easier before we had calculators or computers. Now of course that's not an issue today, but the convention has stuck with us. So make sure when you're calculating the interest you divide by 360 instead of 365. Next, we need to figure out how many days the note is outstanding in 2009. Well, the note was created on November 17, and there are 30 days in November. So if we take 30 minus 17, we get 13 days in November. And then we add 13 to the 31 days in December to get 44 days in 2009. So that's going to be 44 divided by 360. Now the easiest way to find 2010 is to recognize that, well, we've already recorded 44 days in 2009, and there needs to be 120 days in total. So we take 120 and we minus the 44 days that we've already recorded to find that there are 76 days still left to record in 2010. So that's going to be 76 divided by 360. Alright, we have finished our interest table here. Now we didn't really need this for the first journal entry, but it's just kind of nice to get it out of the way. So the first transaction says we signed a $10,000, 8%, 120-day note dated November 17 in exchange for cleaning services. Alright, so since we are getting cleaning services, that's an expense to the company, so we could title that cleaning expense. And that's going to be for $10,000. And then we have to record the notes payable, which is also going to be for $10,000. Next, on December 31st, we need to prepare the year-end adjusting entry to record the accrued interest on the November 17 note. So this is just to recognize that the note was outstanding in 2009, and therefore there's some interest expense that's related to that note that needs to be recorded in 2009. And now we're at the last day of the year, so we need to record that interest expense. So again, over here, the 2009 interest expense is $97.78. So we can increase our interest expense by debiting it for $97.78. But we haven't actually paid that interest yet. It's going to be paid when the note is paid in 2010. So we're going to have to record a liability, which is interest payable, to recognize that we haven't paid this interest quite yet. So next we are in 2010, where on March 17, we're going to pay the principal and the interest on the November 17 note that we've already done all these calculations for. So since we're paying the principal and the interest, the principal is $10,000 and the total interest is $266.67. So if we add those two together, we'll get a payment of cash of $10,266.67. And I know that's a payment, so that's going to be a credit to cash. So I'm going to leave some space, and I'm going to credit cash for $10,266.67. Now I know I'm paying off this note, and it has a balance in the notes payable account of $10,000. So to close that account out, I can debit my notes payable for $10,000. Next, I have this interest payable, which is being paid out, is being included in this cash right here. So to close out our interest payable, we can debit that, again for the $97.78. And then finally, we have some additional interest expense to record for 2010, and that's $168.89. So we record interest expense for $168.89. So just remember that the interest payable in this journal entry relates to the earlier year, which was 2009, and the interest expense relates to the later year, which is 2010. Next, on May 15, we accepted a $30,000 9% 60-day note dated May 15, 2010, granting a time extension for our past due accounts payable. So let's calculate the interest for that. And the reason why we don't need to have multiple years here is because this note was created on May 15, and it's only going to last 60 days. So that means that this note is only going to be outstanding in 1 year, just 2010. So the principal on this note is $30,000. The rate is 9%, so that's 0.09. And the time, they tell us it's 60 days, so that's going to be 60 divided by 360. And if you multiply those three numbers together, you get interest expense of $450. So now let's record the journal entry related to this note, and that was for the acceptance of a $30,000 note for a past due accounts payable. So we're going to be transferring our accounts payable balance to notes payable. So we have to decrease our accounts payable for that $30,000 amount, and we have to increase our notes payable, and that's also going to be for $30,000. Next, on July 14th, we paid the principal and the interest on the May 15th note. So the interest on the May 15th note, we already calculated that to be $450, so we can record interest expense for $450. Now we have to close out this balance for the notes payable since we are paying it out, so we can debit notes payable for $30,000. And then of course we are paying out cash, so we can credit our cash account, and that's for the total of the principal and the interest. So that's $30,000 plus $450 is $30,450. Next, on December 3rd, we accepted a $20,000 7% 90-day note as a loan from B. Clinton. So we're going to need to complete one of these tables again. And again, we need 2 different years because this is a 90-day note which started in December. So it's going to be collected in 2011. So maybe I'll give you a minute now to see if you can complete this chart, and we'll see you back with the answers in just a moment. Alright, we are back with the answers for this chart here. So this note was worth $20,000, so that's the principal. The rate was 7%, so that's 0.07 for all rows. The time period in total was 90 days out of 360. For 2010, since the note was created on December 3rd, if we take 31 and we subtract 3, we get 28 days remaining. So there's 28 days in December, which is the total for 2010. So that's 28 over 360. And then to find the 62 days in 2011, you can just take the 90 days in total and subtract the 28 that you recorded in 2010 to get 62 days. And if you multiply the principal times the rate times the time, you should get these 3 numbers for the interest expense. So now let's record the journal entry. So we accepted a $20,000 note from B. Clinton, and that was as a loan. So that means we are getting some cash. We're taking a loan out, and that's going to be for the amount of $20,000. And we're going to have to pay that back later in the form of a note, so that's going to be notes payable, also for $20,000. Next, on December 31st, we need to prepare the year-end adjusting entry to record the accrued interest on the December 3rd note. And this is just to recognize that this note was outstanding for some time in 2010, and therefore some interest expense needs to be recorded in 2010. And we already calculated that to be $108.89. So that's going to be interest expense for $108.89. And since we have not paid that yet, it's going to be interest payable, also for $108.89. Finally, on March 3rd of 2011, we are going to pay the principal and the interest on the December 3rd note. So in many ways, this is going to be similar to the March 17th payment of the note, since this one was also over the calendar year. So maybe I'll give you a moment now to pause the video and see if you can come up with the answer for this final journal entry. Alright, we are back with the final journal entry. The notes payable is just going to be for $20,000, and that's going to be a debit to close out the balance that we had from earlier, since it's being paid off now. The interest payable is to recognize that some of the interest expense from the previous period is now being paid, so that's closing out this interest payable from before. We also have some additional interest expense that we're recording in this period, which is the 2011 amount of $241.11. And of course, the cash is equal to the principal plus the interest, which is $20,000 plus $350, which is $20,350. Alright, we are done with the final journal entry. And I know all this might look a little intimidating at first, but as long as you practice, it's only going to get easier.